Okay, this is video 3.1 that is going to cover problem 313B from the 22nd edition. I do have this template posted in Brightspace, so you can download it and either do it directly in Excel as I do this, or you could print off a hard copy and do it by hand as you follow along with the video. We're going to ignore the book directions, and we are first going to do journal entries, then post journal entries to the T accounts, and then we will prepare a trial balance. And in just a little bit in the video, I have a few summary points that I'll come back and type for you here. I have a tab already set up for the journal entries. I have a tab for the T accounts and one for the trial balance. Before we do the journal entries, I want to review the rules of debits and credits using the T accounts. Remember that the rules of debits and credits are just that. They're just a set of rules. It's just a system. And if you look for a meaning that's deeper than what's there, you're going to be confused. In a sense, you just have to accept the fact that it's just a system and there's a pattern that we follow, and once you get used to the pattern, it makes sense and it's fairly logical, but you still, in a sense, have to just accept it for what it is. And the analogy I always use, it's like the road system. In the United States and in some countries, we drive on the right. In certain countries like England, they drive on the left, and basically their pattern of driving is just kind of opposite of our pattern. But if you understand how our road system works and you're used to driving on the right, it's not that big of a deal to then go to a country and drive on the left because you understand the concept of the pattern. And so again, I'm just trying to make the point. It just kind of is what it is. So let's start with assets. For assets, our rule is that assets are increased with a debit, decreased with a credit. And that's true for every single asset. So I hit Control Copy, and then I'll hit Control V to paste that here, 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 under Equipment, and under the van account. In other words, every single asset follows the exact same pattern. All assets are increased with a debit. All assets are decreased with a credit. Liabilities are the opposite. Liabilities are increased with a credit, decreased with a debit. We only have one liability in this problem. The capital account, increased with a credit. Drawings, increased with a debit. And this is a little bit of a preview for what we're going to talk about in Chapter 6, but basically the drawings or withdrawals, money that's taken out of the business by the owner, an increase to the drawing account ultimately becomes part of the capital account. So I kind of want you to visualize that this account, a debit in this account, ultimately gets put into this account. So an increase to a drawing ultimately becomes a decrease to capital. Same thing with revenues. But revenues are increased with a credit, and that credit eventually gets put up here into the capital account. And same thing with expenses. Expenses ultimately will get put into the capital account, and expenses are increased with a debit. So again, I'm going to hit Control C and then Control V, Control V, Control V, and paste those into the accounts. So that's just a quick review of the rules of debits and credits. Now we're going to work on the journal entries. And remember, this is one system, and so everything should be consistent. You can use the T accounts to help you think about the journal entries, but I want you to be in the habit of doing the journal entries first. Transaction A says invested cash in the business, $30,000. Remember, we're always looking at things from the viewpoint of the business, not from the viewpoint of the investor. So the two accounts involved, cash and capital. I'm going to jump over to the T accounts real quick. Cash increased with a debit. Capital, which is part of equity or owner's equity. I'll go back and highlight these real quick just so that those all look the same at the top. But equity or owner's equity are the same thing, and we are increasing the capital account. That is increased with a credit. So in my journal entry, debit cash, credit capital, and notice I have the cells set up where I kind of have a built-in indentation, so you don't have to sit there and indent every time. And I can clearly see cash is being debited, capital is credited, and then I will put the dollar amount in, so debit and credit, and then let's post that to the T accounts. And remember, if there's a debit in the journal, it's a debit in the T accounts. Think of it as one continuous system. There's never a scenario where I would make a debit to cash here, but then put it as a credit over here. So even though we literally type it in two different places, think of it as a single entry. If we had a computer accounting program, we would enter it once and it would automatically put the information in two different places at the same time. But when we're doing this using Excel, which isn't true accounting software, we literally have to type it ourselves in two different places. Transaction B, purchased a van for cash. Van is an asset, so to increase an asset, I will debit the asset. Cash is being credited or decreased because we are paying cash. And again, if you need to, jump over to your T accounts, look at the van account and say, okay, I need to increase the van. Does it make sense that that is a debit? Yes, it does. And I am crediting cash for $8,000. We are paying cash. Cash is going out of the business. Does that make sense? Yes, it does. And at this point in the semester, it might still sound really weird to say a credit is a decrease, but it is. So for an asset, a credit is a decrease, whereas for a liability or some of our equity accounts, a credit is an increase. Transaction C, purchase plumbing equipment on account, $4,000. So I know equipment is going up. That is an asset. And then those two little words right here, on account, that basically means that we are not paying for this right now. So we have an increase to accounts payable, a liability for $4,000. So equipment, $4,000, accounts payable, $4,000. Transaction D, receive cash for services rendered. You'll hear me say this a lot, but anytime cash is involved, I just think that's an easy starting point for a transaction, especially if you're stuck. So it's very obvious to me that we received cash. Oops. So we will debit cash. And the reason we received cash is because we had services rendered. In other words, we did something. So we are recognizing revenue. A lot of times I just say the word revenue. I keep it very simple. Service fees is the particular revenue account title that this business is using. So the general account is revenue, but they're specifically calling it service fees. And so we have a debit to cash for $3,000 and a credit to revenue for $3,000. Transaction E, paid cash on account. Owed from transaction C, $1,000. So we are paying accounts payable. So debit accounts payable, credit cash. And again, when I go over to the T accounts, I really want to think about, is this making sense? So accounts payable is debited for $1,000. Cash credited for $1,000. And again, that makes sense. My liability is going down and my cash is going down as well. Okay, transaction F. Paid rent for the month, $700. Rent is a cost of doing business, so we will debit rent expense, $700. We see that word paid, so I know cash is involved, $700. Again, when I look at my T accounts, does that make sense? I am increasing my expense with a debit, decreasing cash with a credit. Paid phone bill, $100. So that is also a cost of doing business. Phone expense should be debited for $100. Again, we see that word paid, so we know cash is involved. So we will credit cash for $100. So debit phone expense $100. Cash is credited for $100. Transaction H, earned revenue on account. So this time, we know we're earning revenue. That's very clear. But those two words, on account, you really want to look for that. We don't see the word received, cash. And so on account tells us that what we received was an account receivable. So we're going to debit accounts receivable, $4,000, credit service fees or revenue, $4,000. And so we'll go to accounts receivable. That asset is being increased $4,000. Revenue is being increased $4,000. And this brings up a good summary point that revenue is recorded when it is earned, not necessarily when we receive cash. So what happened is we had an increase to assets, specifically accounts receivable. So an asset went up, and you can think of this side of the equation as almost like an explanation. So we say we have assets equals liabilities plus equity, or we have economic resources and claims to those resources. But I also say that you could think of this as, here are assets, and then this is kind of the explanation as to why did the assets go up or go down. So in this case, why did this go up? Because we earned revenue. And so revenue is not necessarily the same thing as cash. Next transaction, purchased office supplies for cash. So we are going to debit office supplies, an asset. That's an increase. Credit cash, $300. That is a decrease. And let me just clarify this. The reason that we are debiting office supplies, let's go to the T account. The reason that we are debiting office supplies is that we are purchasing an asset. And in accounting, a big picture concept, it's not the purchase of something or the payment of something that means we record an expense. It's more about the consumption. So right now we have not consumed, or I could say we have not used the office supplies. Therefore, we record an asset. When we use the office supplies up, at that point we record the supplies as an expense. But right now, this is an asset. So we debit office supplies and credit cash. J, paid wages to a student. So we debit wages expense $500, record a cost of doing business. We see that word paid. So we have cash, $500. So debit wages expense $500, cash $500. K, purchased a 1-year insurance policy for $800. I'm going to jump to the T accounts real quick. Notice under assets, we have prepaid insurance. That is an asset. Again, it's this concept that we are purchasing something, but we have not yet consumed it. Therefore, right now, it is not an expense. Right now, it's an asset. We have future economic benefit, and the benefit is that we have insurance coverage over the next year. So we are going to debit prepaid insurance, $800. We've paid it. Credit cash, $800. So debit prepaid insurance and credit cash. So one asset went up, another asset went down. It is perfectly okay to have a transaction that is only on one side of the equation, but everything stays in balance still. Debits still equal credits, and total assets did not change. We just had one asset that went down and another asset that went up. Next transaction, received cash from services performed in transaction H. So to me, the more obvious thing is we are receiving cash, $3,000, and it says we're receiving it from the transaction related in H. Well, in H, we got an account receivable. We recorded revenue. Now we're getting some of that cash. So what's happening in this transaction in L is we're getting cash. That asset is going up, but accounts receivable is going down. We have to be careful. We only record revenue when it is earned, not necessarily when we get the cash. If we record revenue here, we would be double counting the same revenue. So cash is going up, $3,000. Accounts receivable is going down $3,000. Which is good. It's good to have a receivable, but it's better to have a cash. So we're happy that this asset is going down because it means that we are getting paid. Next transaction, paid cash for advertising expense, $2,000. So another expense. Advertising expense is debited $2,000. And cash is credited $2,000. Again, I know it probably still sounds very weird to say cash is going down, therefore we credit the account. That just doesn't sound right, but that's our rule here. Advertising expense, $2,000. That's an increase. Cash, $2,000. Is credited to that account, and that is a decrease. N, purchased additional equipment for $2,000. So I'm going to do that first part. We purchased equipment, $2,000. We're paying $500 of it in cash. So we credit cash. It is going down. And we're spreading the remaining payments over the next 6 months, which means we're going to increase accounts payable for the remainder for $1,500. So equipment, $2,000. Cash is going down $500, and accounts payable is going up $1,500. Transaction O, earned revenue $2,800, $1,100 in cash, $1,700 on account. Again, I like to start with cash when it's there. So I know we're increasing cash. We received cash. We also got an account receivable. For $1,700. And we're going to recognize revenue for all $2,800. So cash has increased $1,100, debited $1,100, accounts receivable $1,700, and revenue all $2,800. This is a good journal entry to summarize the point that we recognize revenue whether we received cash, whether we received an account receivable, or some combination of both. But the recognition of the revenue is all about, did we do our part of the deal? Did we provide a service or sell a product? And the last transaction withdrew cash at the end of the month, $3,000. When I look at the T accounts, I can see the drawing account. I am increasing my drawings, which ultimately will become a decrease to capital. I want you to almost visualize this account being merged into this account. In other words, a debit here ultimately becomes merged into this account and becomes a debit in this account. So my journal entry, debit drawings, $3,000, credit cash, $3,000. So debit drawings, credit cash. Okay, now we have completed all of the journal entries, and next we're going to calculate the balances in the T accounts. So I put an extra line in some of these accounts just because it makes it a little bit easier to do subtotals. So I'm going to use this auto sum feature. And in the cash account, I want to add up all of the debits. I want to add up all of the credits. But ultimately, we have to have a single ending balance. We would never stop here and leave it like this. We want to find a final balance. It's either a debit or credit balance. So what I want to do then is I want to say the ending balance is equal to cell A15 minus cell B15. Hit enter, and there's my balance. I'll do the same thing with accounts receivable. And then my final balance would be A22 minus B22, which I can click on this cell. It just wasn't letting me click on that cell. It was kind of covering it up. So I had to type it in. 2,700 Now, on an account like office supplies where we only have one transaction, you can do it one of two ways. I could have that line here, and then I could show the ending balance. So it looks kind of redundant, but that line right here, that bottom line, that's just signaling that we are calculating the balance. Or I could leave it just like this. And I really don't care what you do. It really doesn't matter to me one way or another. So either way is fine. So I'm just going to leave prepaid insurance, equipment. I need to calculate the balance. Van, there's only one transaction. I will leave it alone. Accounts payable. I'll go ahead and subtotal my debits and credits. So E9 minus D9, and we're left with 4,500. I'll just leave the capital account alone, the drawing account alone. Revenue has a normal credit balance, and then all of my expenses have just one transaction, so I'm just going to leave those alone. And then next we can do the trial balance. And all we're going to do with the trial balance is take the ending account balances. So I've highlighted these ending account balances. And so we'll take those amounts and plug those into the trial balance. So cash, 20,200, 2,700 for accounts receivable, 300 for office supplies, 800 prepaid insurance, 6,000 equipment, and 8,000 for the van. So again, an account has either a debit or a credit balance, but not both. So I just put a single balance. Accounts payable was 4,500, 30,000 for owner's capital. The drawing account, 3,000. $9,800 for revenue. Rent, 700. Wages, 500. Phone, 100. Advertising, 2,000. And I already had this auto summed. I'll show you how I did that. I'll delete those real quick. But I simply just used my auto sum feature, made sure highlighted all of those cells. Same thing on the credit side. And the trial balance is nothing more than a list of all of the accounts and their balances, and it shows that debits and credits are equal. Okay, I want to just write down a few summary points real quick. One thing that I wanted to point out, drawings are recorded like expenses. So both drawings and expenses are debited. So I'm going to go over here, summary points. Okay, so drawings are recorded like expenses. A second point, both drawings and expenses reduce equity. However, only expenses go on the income statement. And this is kind of redundant, but I just want to be very clear on my point. Drawings never go on the income statement. We look at drawings very differently than we do expenses. So I want you to think of drawings when we look at things from an investor perspective. it is possible for an owner of a business to be both an employee and an investor. But in this class, an accounting class, we're going to really think of drawings as looking at things from a business owner viewpoint, and wages thinking about other people that work for the business. Even though in a real life scenario, it is very possible for a business owner to be both an employee and an investor. But we just specifically mean the word drawings to talk about things from an investor standpoint. And then one more point that I wanted to make about the trial balance is the trial balance is not a formal financial statement. Okay, so the trial balance is not a formal financial statement. Okay, the trial balance is not a formal financial statement. It is simply a trial balance is simply a list of all accounts and their balances. One other thing we could add in there, the trial balance shows the equality of debits and credits. In other words, the trial balance shows us that debits and credits are equal to each other. Okay, that is the end of this video. Hopefully that was helpful, and this should be very helpful in completing one of your homework assignments that I will have you do in Excel and then post to Brightspace. So let me know if you have any questions. Hope you have a great day. Thanks.